The more marketable it is, the easier it is to sell, the less discounts it is. So a company that has strong financial statement strength, that has strong management, that is issuing dividends or distributions, or that has no restrictions on transferability is going to be more marketable versus the converse would be less marketable, and there's a price that needs to be adjusted for those components.
Hello, and welcome to another episode of It Depends, a podcast series brought to you by Hanseman Weeble. You know that if you've ever talked to an accountant, they've told you, well, it depends. This podcast series is for business owners, leaders, operators, accountants, or someone just wanting to learn more about the accounting industry. I'm your host, Clarissa Hoffman. Today we are joined by Mark Wheeler to do a deeper dive into business valuations. Thanks for being here, Mark.
It's a pleasure, Clarissa. Thank you for hosting.
Absolutely. Can you tell us a little bit about yourself?
Absolutely. I'm a partner here in the advisory department. I've been with Hanseman Weeble 13 years, and it has been a blast.
All right, so we're going to jump right in. How does one go about valuing a business?
That's a great question. Generally, we start with the historical financial statements. We look at the income statement, the balance sheet, and the statement of cash flows, oftentimes the tax returns too, to try to get a feel of what the business has done historically. We spend a lot of time with management. We interview them. We need to understand as much about the company as we can. That includes their human capital, their strengths, their weaknesses, their competition, what their growth trajectory is going to look like. And depending on what type of company we're looking at and what type of valuation we're preparing, then we apply one or more of the valuation methodologies.
So tell me a little bit more about those different valuation methodologies.
Of course. There are generally three main valuation methodologies, and each one has a few sub-approaches. They're the income approach, the market approach, and the asset approach. For the income approach, depending on the state of the company and the trajectory of the company, we might rely on normalized historical earnings and capitalize those with the capitalization rate. That's if the company is going to be stable or we expect the past is going to look like the near future. If the company is changing or it's in a non-linear growth trajectory, then we'll ask management to put together a series of projections or forecasts, and we'll discount those back to present value. Now, I use the term discount and capitalization rate. Those are essentially the inverse of each other. You might have heard, 5 times EBITDA. That would be the same thing as a 20% discount rate. Mm-hmm. The second approach is the market approach, and we can look at sales of comparable companies, whether they be private companies or public companies, and then help infer value based on the multiple of revenue or the multiple of earnings that those sold for. Conversely, we can also look at public companies that haven't been sold, look at their stock price as of our evaluation date, and pull publicly reported data for number of shares, earnings, and revenue, and infer how the market is pricing those assets. The last one is the asset approach. This is typically used when the value of a company's assets are greater than the value of its cash flows. You'll see it in holding companies or family limited partnerships. Oftentimes we see it in real estate companies and farms that are LLCs or partnerships.
So you mentioned valuation discounts. Tell me a little bit more about those, please.
Absolutely. This is one of the more interesting and more subjective areas of business valuation. Under the fair market value standard, we generally consider and often apply two main valuation discounts. Those are discounts for lack of control and discounts for lack of marketability. The discount for lack of control is meant to capture the proportional disadvantage or advantage to having control versus not having control. That could be a minority interest of 49% or lower, or it could be a limited partnership interest as compared to a general partnership interest. The idea here being that a minority or lack of control owner does not have the ability to set salaries, issue bonuses, make distributions or dividends, force the sale of assets, or sell the company. So in effect, there's a risk that the minority owner, certainly they're at a detriment, but they could also be frozen out of the earnings stream, and we have to quantify that. The marketability discount captures the difference between public stock and its transferability versus publicly traded stock. So Google stock you can trade into cash in a matter of 3 days. Stock in Guadalajara or Hanseman Weeble cannot be so easily converted into cash. And there are a variety of components that go into how marketable that is. The more marketable it is, the easier it is to sell, the less discounts it is. So a company that has strong financial statement strength, that has strong management, that is issuing dividends or distributions, or that has no restrictions on transferability is going to be more marketable versus the converse would be less marketable, and there's a price that needs to be adjusted for those components.
When we met with Chris to do an introduction to business valuations, he talked to us about the different reasons that someone might do a valuation. How does the purpose of a valuation impact your conclusion as to the value?
Great question. The purpose of the valuation is really going to drive what we call a standard of value. And there are a few of those I'll go through. The most common one you'll hear is fair market value. That's an IRS construct, right? So for 409A stock valuations or gift and estate valuations that we're doing for compliance purposes, we use fair market value. That definition is the value between a willing buyer and a willing seller, with both having equal knowledge of the facts and neither being under a compulsion to act. So it's a bit of a fictitious construct, but it's meant to create a level playing field. Under the fair market value, we consider and or apply the valuation discounts that we talked about earlier with control and lack of marketability. Fair value is another standard of value we often see. It's essentially fair market value without the discounts. Think about a divorce setting where you need to divide something 50-50. A 50% interest under fair value is not going to be discounted, whereas under fair market value you might apply some. It's meant to be equal parts, right? You might also see it in shareholder dissolution cases. Investment value is more of a real-life standard of value. You'll see it in mergers and acquisitions. That's the value to a specific buyer. So if I am an insurance company and I'm buying another insurance company, 1 + 1 doesn't equal 2. 1 + 1 often equals 3. And you're willing to pay a premium for that because you can consolidate your accounting department, you can consolidate your marketing department, perhaps you're opening yourselves up to new carriers or new markets or new producers. And so that's investment value. The final one is liquidation value. That's for a distressed business, similar to the asset approach that we talked about earlier, where a company is not profitable and needs to sell some or all of its assets and may in fact have to close its doors.
So who can provide a valuation? Can any CPA or financial professional do so?
They certainly could. The general rule of thumb is those who hold themselves out to be valuation professionals. It's very vague and it could be a little bit troublesome in some aspects. I would certainly recommend to anybody who's looking for a valuation professional or an appraiser to find someone that has the skills, the education, the knowledge, and the experience necessary. Certainly accountants or CPAs, that designation holds a lot of weight. Chris Brubaker and I are both ABVs, which is accredited in business valuation through the American Institute of Certified Public Accountants. Some other common ones you'll see are CVAs, or Certified Valuation Analysts, or ASAs, Accredited Senior Appraisers. Either way, you need to be able to understand and create a report that is defendable for your purpose. If it's going to the IRS, it needs to check all the IRS boxes. You need to be able to understand the industry that the client is working with. You need to be able to synthesize perceived risk and expected return to come to a cogent, defendable answer.
So we talked about there are different methodologies, different purposes for having a valuation done, using a discount or not using a discount. How do you know that your number's right?
That's a great question. If you're going to give the same fact set to 10 different evaluators, you're going to come up with 10 different answers. And that's okay. We all have different experience and different judgment and different inputs. Hopefully those 10 different answers, the dispersion is all fairly tight. At the end of the day, we need to determine that under our standard of value and for the purpose which we're doing the valuation, that given that perceived risk and expected return, that buyer would be able and willing to pay our conclusion of value for that interest.
Well, thank you so much, Mark. This is very helpful.
Always a pleasure, Clarissa. Thank you. What's your next podcast topic?
Well, it depends.